Welcome everyone. This is Disruptive Real Estate Trends, and I'm going to turn on my camera. So this is an annual webinar, and it's being presented for the 10th year. So this is our 10th year of doing real estate trends, and this is a data-driven, very chart-heavy collection of eye-popping insights, and hopefully it'll help you make high-quality investment decisions. We're going to shine a light on the best real estate opportunities in the country. Everything that you'll hear about today, it's focused, it's actionable, it's tangible. There is no upsell. There's no subscription. There's no higher tier. We won't even be pitching one of our projects. I mean, this is just pure content. It's for fun. It's for learning. Before I go into the fun part, for those of you that don't know Anna and I, um, she's my partner, and we are quirky and opinionated data scientists and technologists, and we buy and build large projects. Our portfolio of 25 properties is currently worth about $660 million, and over 1,200 data-driven, somewhat geeky investors have trusted us with their money. Here's one half of our portfolio, and we use data science and we invest in 8 different asset classes. So you got multifamily value add, apartment new construction, single family built to rent, fourplex built to rent, student housing, built to sell townhomes, self-storage, and also flex industrial, right? So each of these asset classes has taught us something different and hopefully made us better at our job, which is to protect your investment. And we've gone full cycle 9 times on these projects with an overall IRR, if you know what that means, of 33%, and overall AAR, average annualized return, of 40% across those 9 exits. And I'm especially proud of our last 2 exits because both of those exits came in the last couple of years. So the very difficult real estate market, and we still beat our own projections on those. So we are looking forward to number 10 this year, later in 2025. Our investors like what we're doing. So here's Jennifer. She's a super experienced investor, and she compares us to much larger companies that have more projects, and she thinks that we still come out ahead. And she enjoys our high efficiency processes. She likes the fact that our team really hasn't changed much since the beginning. Here's Dr. Pada. He's a general partner with lots of deals on his own, both as a general partner and as a passive investor. Check out his comments in orange. It comes down to true use of data to optimize results, and we're good at that. All right, let's get the boring legal stuff out of the way before we get into the webinar. Just a friendly reminder, this webinar is for educational purposes, and just because we're sharing our personal opinions doesn't mean you're guaranteed to make a fortune in real estate. So please do your own research, consult professionals, and remember that investing in real estate and stocks is risky stuff. And don't be shy to type in your questions. We do our best to answer them at the end. This particular webinar gets a lot of questions. Don't worry, if you miss anything, we will be sending out a recording of this whole shindig tomorrow. All right, let's get started. You know, a lot of politicians love to talk about US exceptionalism, and I mostly like to ignore what they say. But it's really very hard not to acknowledge that the US was exceptional in so many different ways in 2024 because our economy, it wasn't just extremely resilient. You know, when you compare it with other major economies, we weren't just ahead. We were in a complete class by ourselves. So I do hope I get to say this again in the future, but the US economy, it just crushed it, right? Absolutely crushed it. And in 2024, the US stock market led the entire developed world. And you can see here, the S&P 500 returned 25% for 2024, which is an astonishing number, given that the previous year was also a really good year. So our top stock returned 171%, NVIDIA. And the fact that we did this despite extremely high interest rates really showed how strong the economy was for 2024. And maybe the stock market isn't the very best indicator to show strength because it's, volatile, goes up and down, right? But a better indicator is the US dollar. Yeah, and I like that graphic. As you can see on the right side, the dollar was the only major currency in the world to appreciate against all of its peers. As you can see, all of these are competitors. They're trying to put up a currency against us, especially this group you've heard of called BRICS, B-R-I-C-S. So take a look at the lines for the Chinese yuan, the Indian rupee, the the South African rand, the Brazilian real, and the Russian ruble. These are the 5 currencies we are up against in the BRICS consortium. We crushed all of them. And the other metrics that everyone looks at, they were also extraordinarily strong. These are the four that we look at the most, right? So job creation for the year, close to perfect, 180,000 jobs a month. A perfect year is 200,000 jobs a month. Inflation started the year in high threes, actually low fours, and ended up at the end of the year right around 2.6, 2.8. There's actually some indication that it's going up a little, which is worrying, but inflation rarely goes down in a straight line. Consumer spending extremely strong because it grew 3.1%, so it grew faster than GDP, faster than inflation. And then energy prices were down 7% for the year because the US produced more oil and gas than Saudi Arabia, and it grew its lead as the largest oil and gas producer in the world. Basically, in 2024, the US economy said, gravity who? Right? On the left side, you can see our growth compared to the G7, the OECD, the Eurozone, and other countries, UK, Japan, France, Canada, Australia, pretty much beat the crap out of everyone. Again, we briefly mentioned inflation already, but I think this chart that's on the left is actually very instructive. So we've come extremely far from this peak of inflation at 9%. That was in June 2022. It's taken us 2.5 years to get down to a more reasonable level. And we did see an uptick in January, by the way, and we have to guard against that. But most analysts think that we are on track for inflation to be a little bit under 3% this year in 2025, right? Don't think we're going to get to the Fed's target, which is 2%, but even high twos would be pretty acceptable. That's not bad. Job market, well, the job market in December 2024 was basically the equivalent of a surprise party, right? No one expected it, but there it was, booming, 256,000 new jobs. Our expectations were 160, so we blew past that. Unemployment ticked down to 4.1% in December, and then in January, by the way, it ticked down to 4%. So it showed that the labor market is still very resilient. But there's a catch, right? So this strength in the labor market is a double-edged sword. It's great for workers, but it really complicates the Fed's decisions on rate cuts, right? So it's trying to drive with, one foot on the gas, one foot on the brake. So it's very jerky. So the Fed cut rates last year, and naturally we all expected mortgage rates to, follow suit to go down. But they didn't, right? So despite the Fed pulling its levers, these mortgage rates, they're like the one buddy that's just refusing to take a hint, unfortunately. They're stubbornly high. They're hovering around 6.9% for a 30-year fixed. And why? Because these mortgage rates, they're not just tied to the Fed's cut, right? There's a lot of different factors, long-term bond yields, inflation expectations, even investor sentiment. All of this affects, treasuries, which means that mortgage rates are still staying high. All right, so that was kind of a initial sort of look at where the US economy was in 2024. But let's talk about our first disruptive trend in 2024, right? So artificial intelligence, AI, because while interest rates were keeping everybody on edge, AI was transforming the business landscape because in 2024, it wasn't the buzzword that it was in 2023. It actually became a key driver of revenue growth. So companies that are leveraging AI early, they saw productivity gains, they've seen cost reductions already, and in many cases, they're seeing these crazy skyrocketing valuations. The economic impact of AI is undeniable, right? We're talking about a 21 trillion, read my lips, $1 trillion boost to the global economy in 7 years. That's not just a ripple, that is a tidal wave. And for real estate, expect shifts in demand for office spaces, changes in industrial layouts, even impacts on residential preferences because remote work is continuing to evolve, right? Not everyone's going back to the office. So the future isn't coming, it's already here. So this slide actually digs a little bit deeper into that $21 trillion gain in world GDP in 7 years, right? Because that's not just a headline, guys. That is a reboot for the entire world economy. AI is expected to add this staggering amount to the global economy. In 7 years, every sector benefits: healthcare, finance, transportation, and yes, real estate, right? AI is going to streamline property management. It's going to predict market trends with unbelievable accuracy. You might not even need this webinar anymore. It's going to optimize energy efficiency in buildings. It's going to do so much in real estate, right? And this insane growth that's happening, it's because of something known as Moore's law. So there's this idea that computing power doubles roughly every 2 years, but AI is not like that. It's accelerating faster than that. So since January 20th of this year, right? What's the date today? The 12th. So since January 20th this year, a tool called DeepSeek came out, right? So in 22 days, we have seen token speeds worldwide double in 22 days, not in 2 years. So imagine AI algorithms that can, analyze millions of data points in real time to forecast housing demands, rental price fluctuations, and even pinpoint the next hot investment market before anybody else sees it coming, before Neal Bawa sees it coming, right? All of that is going to happen in the next 12 to 24 months. So for investors, this is huge because the world economy, all of it, will morph dramatically in the coming years. AI is the single greatest disruptive trend featured in 10 years of this presentation. It's the mother of all disruptions. 25% of all American jobs are exposed to automation from AI over the next 5 to 10 years. Probably not in the next 2 years, but 5 to 10. So this is a dual-edged sword, right? You can see on the right side, we're going to get much faster world GDP growth, much faster, right, than in the last 10 years, much faster. Unfortunately, more of the benefits are going to go to the rich and to the people who've invested in the stock market. So there's definitely long-term concerns about growing income disparity because of AI. All right, so we covered what happened in 2024. We covered our biggest disruptive trend. Now it's time for section 2. We looked at 2024. Now we're going to look ahead. We're going to look to the future, economic forecast for 2025. Remember, this section's not real estate forecast yet. That's the next one, right? But all of those forecasts in that next section, they're based on the economic forecasts in this section. What's on the horizon for 2025? So think about an economy that's gently easing into stability, right? What we mean by a soft landing, right? So GDP growth is expected to hover around 2.5, 2.25. That's solid, not flashy, steady. Unemployment projected to stay low, around 4.1%. That's great news for job seekers, for consumer confidence. CBRE, who basically gave us these numbers, thinks inflation should continue to cool in the 2 to 2.4% range. I think they're bullish. I expect inflation to be closer to 3%. But I have to admit that most analysts that I've read to prepare for this presentation, they're all showing inflation numbers close to CBRE's number rather than mine. So the key takeaway is, yes, tariffs are coming, and yes, Trumponomics is the next factor. But we think for this year, there may not be any major shocks in the world economy. You might see steady, predictable growth. And we'll see if I was proven wrong. GDP growth in 2025 expected to be steady. So not as fast as last year, which was 2.7, which, by the way, our prediction was 2.6 a year ago. We're looking at around 2% GDP growth. That's so steady Eddie. But as you can see here in this slope, the brakes are going to be lightly tapped as the year goes on. What about the jobs forecast? Yes, we are very concerned about the potential of AI to reduce jobs in the medium and long term. But in the short term, there is zero doubt that AI is boosting demand for jobs. If you look at this list of the fastest growing jobs, they're on the screen. They're all in AI, machine learning, big data, cybersecurity, all connected to each other. And here's our prediction for the unemployment rate. So last year was at 4.1%. And we agree with the conference board's prediction that we're likely to stay at a low unemployment rate for 2025, 2026. So you see these numbers on the screen. By 2027, which is a year beyond this one, we should see significant job losses because of AI. But the next 2 years, we should see significant gains in jobs because of AI. Okay, after predicting GDP growth and the unemployment rate, our third prediction is wage growth, right? Now, it may not feel like it to the people that are listening to this webinar, but average wage growth has actually been growing significantly faster than inflation for almost all of 2023 and all of 2024. So here, on the right, you see this orange line? That's wage growth. And you see this? That's inflation, right? So that this gap means that wages are growing faster than inflation. So for next year, you notice these are coming together. We're predicting that wages are just likely to grow as the same level of inflation, so around 3% for 2025. And we're going to need that 3% to grow rents because, as you're going to see, we're finally going to raise rents after 2 years of no rent growth. Our next prediction is rate cuts, the Fed rate cuts. So 6 months ago, the Federal Reserve itself predicted that they will cut the rate 4 times by a quarter point each sometime in 2025. But guys, that was 6 months ago. The economy held up so much better than the Fed thought it would that now, today, the Fed dot plot shows 2 interest rate cuts of a quarter point in 2025. Personally, I have to agree with that. I find it crushing that they're going to drop rates this slowly. And so I'm hoping for a third rate cut because if you get 3 rate cuts a year, apartment values would be substantially higher next year. So keep your fingers crossed. All right. Our last prediction for 2025 is about Trumponomics, right? Any new president is an X factor, but it's fair to say we've never had an X factor like the second Trump administration. Everything that he's doing is going to have an outsized impact. And remember, this time he controls the House and the Senate, so he can do more, right? So let's go down the list. First, tariffs. Tariffs can boost inflation. They can increase construction cost. Then there's immigration. It can increase labor costs, especially for new construction. And these tax cuts that he's talking about, they've got positive and negative benefits. So you get higher income, higher spending. But then that comes with higher inflation and higher interest rates because the deficit goes up. Deregulation is generally great. It may have long-term downsides like the 2008 crash, but in the short-term run and the median run, the more he deregulates the economy, the better for us. And the stuff that Elon Musk is doing, and I hope he continues doing it despite all these aggressive attacks from all directions, that's only going to help because it would lower the federal deficit. Yes, it increases unemployment a little bit, but it's more than worth it because it sends the right signal to those foreigners that are buying US treasuries. If the US makes somewhat of a sincere effort to tweak its spendings, any negatives that we're going to see from higher unemployment, smaller government, are going to be more than made up by significantly cheaper treasuries. And that leads to a lot lower interest rates. So massive X factor. Don't know what's going to happen. I've seen projections of inflation going as high as 3 from the 2.2 that we would get in a normal scenario. I've seen construction costs going up by as much as 8% if all the tariffs are implemented and we somehow manage to send back 1 million illegal immigrants. We're currently on track to send back 300,000 based on what we've done so far. But let's assume we do 1 million. Well, construction costs in the US could be going up by 8%, right? So factor all of these into your thinking. Now, on the positive side, high inflation, high labor costs, they're actually good for existing buildings because they're already built, right? So high inflation leads to people earning a lot higher salaries, and so they can afford to pay more in rent. So keep that in mind. It's not all bad. All right. So I'm done with all that dense economic stuff. Now for more interesting stuff, real estate, right? We're going to start with a 2024 flashback. Then we're going to get into the business of forecasting both single family, that's our first section, and then multifamily performance in 2025. We'll start this section also with speculation about Trumponomics. Now we're talking real estate, right? Trump wants to extend the opportunity zone program. That's great for real estate. It's great for investors, right? Because you get significantly higher value, you get these huge tax benefits. They bring a ton more money into real estate, right? And as I mentioned, tariffs are actually favorable for existing real estate, not new construction, especially multifamily, right? He also, by the way, wants to privatize 2 companies, 2 government agencies, Fannie Mae, Freddie Mac. That could affect multifamily financing, but that's a long shot. Probably won't happen this year, probably next year. Climate regulation is definitely happening, right? And that's going to reduce construction costs because a significant portion of our construction costs are actually tied to climate mandates. All right, I'm done with Trump, with tariffs. Let's look at what happened in 2024 just from a single family perspective, right? So there were some very big swings. But if I summarize the winners in blue on the left and the losers on the right in blue, in orange, here's the big summary, right? So most of the price gains were surprisingly in the northeast of the country and in the Midwest. So New York State, not Manhattan, New Jersey, Pennsylvania, they were the big winners because they had the affordability. They hadn't seen the massive increases in rent that we saw in all these boom towns in the Southeast. On the other hand, the big losers were basically the hot cities in Florida and the hot cities in Texas. Now, oddly enough, Louisiana had a really bad year because some portions of the state lost access to insurance. But otherwise, the loser list on the right is really Florida, Texas, right? Overall, it wasn't a bad year for single family at all. On an annualized basis, home prices in the US continue to increase. So the National Association of Realtor, they said the increase was 4.8% last year. Reuters came in with 4.7%. The FHFA, financing agency, they said 4.3%. So basically, prices went up by 4-ish% last year, right? Not bad, given interest rates were almost between 6.5% and 7% for the whole year, right? So single family was astonishingly resilient in 2024. What about predictions for mortgage rates in 2025? All over the damn place, right? Nobody can make up their mind, right? I'm not fond of these guys, the National Association of Realtors, but I have to put them in because they've actually been right the last 3 years. They think mortgage rates will be low. They'll be as low as 5.8. It'll be awesome if that happens, right? But then we've got the group in the middle, the majority. They're thinking 6.3 to 6.4%. I'll take that. Redfin is bearish, and they think that rates are going to be higher because they're worried about the U.S. fiscal deficit, driving up Treasury costs. They may have a point. I do think that the National Association of Realtors might win this one, even though the odds are probably against them. Moving on, our 2025 prediction for home price increases, right? One thing is consistent. Everyone thinks that they're going to go up, right? Of the dozen or so sources that we use to build this presentation, absolutely no one felt home prices would be flat or would be negative. And no one was overly bullish, actually, with Goldman Sachs being the most bullish right here at 4%. And what is really interesting is that the National Association of Realtors, NAR, right there, they're the guys who thought interest rates were going to be really low in the last slide. So I expected them to be far more bullish, but they're only predicting a 2% increase in home prices. So I'm gonna go with them. I'm gonna say 2% increases in home prices next year. And you've probably seen this slide before in our presentations. This is known as the lock-in effect. It is worth mentioning it once more. So homeowners with ultra low mortgage rates, they're not moving, right? That's keeping inventory tight. This lock-in effect happens because homeowners like me were reluctant to sell because our current mortgage is way cheaper than what we get in the market. So there's fewer homes for sale. There's less price competition. There's this upward pressure on home values, right? And for investors, that means that rental demand is going to stay strong because buyers are struggling with affordability. So the key takeaway of this slide, the lock-in effect, is we've got fewer move-up buyers. And so the housing market's going to stay constrained, and that's going to keep prices elevated for much longer than you might expect. If you're looking to become a landlord, this slide is probably the most important for you. In 4 years, salaries in the United States are up 25%, right here. And the average mortgage is up 110%. It's shocking that neither presidential candidate was screaming about this, right? Because they were busy with much more important stuff like climate and transgender people. No, hey, what do I know, right? So this gap, this huge gap between mortgage payments and salaries is absurdly high, and it's still widening, and it's putting more and more pressure on home affordability, right? Wage growth just is not keeping pace with home prices and interest rates, and that's making home ownership impossible for tens of millions of middle-class buyers. And that's fueling the demand for rentals. You're going to see we just had one of the greatest quarters in our history because more people are getting priced out of the market. All right. This is actually a very interesting, colorful slide. So this big circle on the right, it's showing you how unaffordable homes are, right? So the top of the circle, the darker part, this is the least unaffordable. So no surprise, right? Hawaii, California, least affordable. And then as you go down, the affordability increases. And at the bottom, you've got West Virginia, Iowa, and Kansas being the most affordable in the US. But even an affordable market like Kansas is now at 3.2x price to income. And that's already a pretty high ratio compared to 5 years ago, right? So we're left with two reasonably priced markets in the entire United States, Iowa and West Virginia, not my favorites, right? So everything else is really becoming terribly expensive, and that's great for landlords, and it's terrible for the rest of the country. I do like to show off the top 10 most unaffordable big cities in the US because I like to bash state governments. In San Francisco, 76% of your income is needed to buy a median priced home. Just absurd, right? 76%. I don't know how they get mortgages. Los Angeles is worse at 77%. And now, for the first time, a market in Florida. Florida is at 63%. Miami, right? So this affordability infection, it's spreading to places like Denver and Miami. So it's not just a coastal thing anymore, right? It's just everywhere. So here's an updated slide that you may have seen last year. Last year, the median income in the United States required to afford the median home, right here, was 113K. Now it's 116K. And the shortfall between the income that people actually have and the income that's required to afford the home or qualify for a mortgage, huge, $33,000, right? So people just cannot qualify to get loans. In this slide, it's not the sexiest, but it really ties together the single family market in the last 5 slides. The black line is the median monthly mortgage payment in the United States. That's the black line. And the green line is the median multifamily rent, right? So you'll notice that until 2021, these lines were pretty much tracking each other, pretty much, right? Small deviations, but overall tracking. And then what happens, what the F happens after COVID, right? This point, this gap between mortgage payments and rents, it just goes crazy, right? This incredibly large. If anyone tells me, any one of you tells me that after looking at this graph, you can't figure out why you want to be a landlord, I have to send you some Ritalin because you need it, guy, right? This gap is astonishing. We've never seen anything like it. And that massive gap from the last slide means that renter behavior is changing, right? About 20 years ago, only about 27% of renters in the US stayed renters for more than 5 years. Well, that number is now up to 34%, right? So they're staying longer, and that's raising profits for landlords, right? Part of the problem is that, relocation expenses have almost doubled in the last 5 years. So U-Haul costs more and broker fees cost more. So people just stay where they are. They're not moving as much. So as a result, renewal rates on leases in the US for multifamily are rising. In blue, they're rising for Class A. In orange, they're rising for Class B. In gray, they've already risen for Class C. So these are the best numbers we've seen in a very long time. And those of you that are in the landlord business, you know that our biggest cost is turnover, right? We call it churn, right? Turnover, churn. And now we're starting to see historically low numbers for turnover because people simply can't afford to leave. So now everything that I've showed you, right, just a little teaser of what the big guys, the institutional $10 billion guys, they see in the data, right? And these guys are getting crazy bullish about the rental business, right? Sure, if you look at the two really tall bars here, so this is, the institutional guys went a little crazy in 2021, 2022. Since then, you can see they've been a little more balanced, right? But these were the 2 years that there was no rent growth. There was much higher interest rates than we have today. And they're still putting in the same transaction activity as they did in 2015 when interest rates were at 4%, right? These guys employ a gazillion bean counters, and they're continuing to pour money into commercial real estate, but especially pouring it into apartments. And those guys, the big guys, they pay a huge amount of attention to this, to construction pipelines. By now, if you follow our webinars, you know that supply is a very big deal. More supply, lower rent growth. So when we look at this graph, basically the huge portion of supply is just going into 3 areas, the green ones, right? So everyone's building an industrial because of AI. Everyone's building data centers because of AI. And everyone's building healthcare buildings because Americans are getting older, right? Multifamily, on the other hand, nice, balanced, right? Especially in the next 2 years. Office is balanced because the demand is going down, right? So the real threat of incoming supply is if you're buying industrial properties right now. So be careful. That market could flip the next time the Chinese come up with something better than DeepSeek. And this has to be my favorite slide of all time. Sometimes I just feel, gloomy, and I just basically watch this slide and I say, the future's good, right? There's a lot of stuff on this slide, but just focus. Don't look at the green line, right? Just ignore that. Just focus on these blue bars, right? In Q4 2024, last quarter, we absorbed, the US absorbed 667,000 new apartment units on an annualized basis. That is an absolutely mind-boggling, batshit crazy number. And yes, it has happened before, right here, once, right? But come on, the government was helicoptering trillions of dollars into people's pockets when this happened, right? That money's gone. So today, to get an annualized absorption number of 667,000 units, 2/3 of a million new units that just happened, is nuts. If the apartment industry weren't so beaten down with all the interest rate issues in the last 2 years, we'd all be screaming and celebrating. We'd be throwing massive parties because this number is phenomenal. America is producing record number of rental households. Massive, massive absorption. That's phenomenal for landlords, right? So absorption, best ever, right? What about supply? Well, whether you're a single family landlord or a multifamily landlord, you know that incoming supply in the multifamily arena is going to hurt your rents, right? Here's the best news. Look at 2024 supply. Ouch. We delivered 692,000 units this year. We pretty much absorbed all of them, right? But not all of them, not exactly all of them. And that's why we didn't get any rent growth in 2024. Vacancies actually picked up, occupancy dropped. But now look at the red line, completions for 2025. We're going to deliver less than half of the units that we delivered in 2024, less than half. And that is why every single rent projection for 2025 is massively bullish. We probably won't absorb as many units this year as we did last year, but I'll be damned if we don't need more than the 342,000 that are in the red line. And what happens when demand is higher than supply? Rents for single family spike, rents for multifamily spike. And they don't spike evenly, by the way. Boomtown, Southeast markets, they still have a lot of delivery coming in 2025. So they're going to see smaller rent gains, right? Than markets like Indianapolis or Kansas City that don't have almost any supply in 2025. And that's why, by the way, Kansas City is projecting 6% rent growth, where boomtown metros are projecting 1 to 3% rent growth. So where are all the markets that have a lot of delivery coming in? Well, this sun over here should clue you in, right? So almost all of the supply is in the Sun Belt, right? So right here, Charlotte, Miami, Nashville, Raleigh, Orlando, Phoenix, Fort Lauderdale, Austin, they all still have a lot of supply coming in, right? Though as a percentage of their total inventory, these numbers are all better, far better than they were last year for every market in this list, right? The markets at the bottom of the left list, like San Antonio, San Jose, Vegas, don't actually have a lot of new inventory coming this year, right? So this level right here, 2%, 3%, these are fine, right? So they're better than last year, right? So you want to be careful buying in markets that are on the top half of this graph or the top half of this graph, right? Anything in the bottom half of this graph on both of these graphs is fine. You should be okay. All right. But Neal, many of you might ask, what about vacancy, right? You did mention that vacancy was higher than usual. Yes. And you can see right here, the graph, vacancy has been going up. That's the green line. And now it's forecast to drop, right? So CoStar, my favorite vendor for data, believes that we've hit the peak of vacancy, and now we should see a downward trend because supply is reducing. And since I'm a real estate guy, of course, I'll always claim good things about multifamily, right? Well, yes, but that's why we have third-party data. This isn't my data, third-party data. Right here, you can see the rent growth in the US. It was pretty awful for this entire gray shaded section. Call it 2 years, right? Pretty awful. Call it 1% nationally. It's probably negative for the Sunbelt metros that had a lot of supply. But you can see here that even a very conservative source like CoStar is showing rapidly accelerating rent growth in each quarter of this year, right? And we grabbed this graph, by the way, before the final Q4 numbers came in. The numbers were so incredible that I'm sure that this graph is going to need to be tweaked upwards. So some good times coming for rent growth. Again, it's going to vary market by market. Texas is going to take much more time than other states to get there. Ditto for Florida. But overall, the industry is quite bullish on rent growth, much more so than the last 2.5 years. Market by market discussion specifically on rent recovery. I've already mentioned this before. Kansas City is at the top of this list. Rent growth of over 6% is projected here. Amongst Sunbelt markets, we see Las Vegas coming back in a rather aggressive way. Surprised by Charlotte because Charlotte basically still has a lot of incoming supply, so it's doing well. On the bottom side here, unfortunately, in the second graph at the bottom, you see San Antonio, you see Austin. They're struggling to rebound. because they still have a lot of supply coming in the first half of 2025. They get better in the second half of 2025. So every other market in the US is positive. So it's good to see Sunbelt markets like Atlanta and Raleigh and Phoenix and Houston, right? Jacksonville. They're all above 2% rent growth, and they've been zero or negative for the last year or year and a half. So pretty much across the board rebound in the US. And so all of this stuff that I just mentioned for multifamily, supply, demand, occupancy, rent growth, it leads us finally to deal flow, right? Sales volume, prices. Well, as you can see, the industry has had a tough time, tough right here. And now look at this. We're super bullish on multifamily for 2025, right? We were in the pits for all of 2023 and 2024. Every quarter, the sales volume keeps growing. And in Q4, finally, we started to see something massive happen. Cap rates went down. Remember, when cap rates go down, prices go up. So we've had our first quarter of cap rate compression in Q4 this year. And the industry feels that that trend will continue for several years with significant improvements in price per unit for the next 2 to 3 years. Very relieved, by the way. So CBRE projects that cap rates will fall by 17 to 25 basis points. And I think they're right there. Delinquency rates. I'm sure there's already some comments in the chat about rising delinquency rates in multifamily. Yes, they're rising. Yes, they're rising pretty fast in the last 2 quarters right here, right? But you can have delinquency go up. This is nothing compared to 2009. We are right here. This is nothing compared to office. They're going up, but this simply means that we'll get more properties in the market to sell. But it is perfectly normal for delinquency to increase and prices to increase at the same time. So we're still projecting increases in pricing. We're still projecting increases in delinquency for 2025. So our final slide is about financing, right? So rents are going to go up, cap rates are going to go down, occupancy is going to go up, which means sales are going to go up. Well, where is all that money going to come from? Well, the good news is that the funding market, the financing market, in great shape, right? The 2 big monster companies, Freddie Mac, Fannie Mae, they actually funded less money in 2023, 2024, so they're flush with cash, and they're looking to deploy more in 2025. To summarize, I don't think that it's a good time to buy single family because single family did not at all course correct during all of the 2 bad years, 2023, 2024. Single family prices are now almost 15% higher than they were in 2022 before the interest rates started going up. Maybe not 15, maybe 12%, right? On the other hand, multifamily is now down 20% since that peak, right? So our summary is rates will fall twice this year. Prices will still be available roughly at 20% below peak. Economy could be stable. The rent versus buy ratio will be massively in our favor, in the favor of renting. And then the rest is up to you, real estate investors. Okay, time to finish. We do our city by city shootout. I know lots of you are here for that, so let's get started. But before that, I want to tell you about our investor club. So this is a club that we've created. It's completely free. There is no cost, there's no subscription. And what it allows you to do, and all of you, by the way, are at this level. So you're all here at this level. But we do we have a massive webinar library, and it's unlimited. It's been given away for free, and the PDFs of all of these decks, right, are given to people that are at the silver level. You don't need to invest with us. You never need to give us any money for education or for investing, but you can get to a silver level by simply having a conversation with one of our investor relations managers, and then you get unlimited access to our webinar library and to the PDFs, including this PDF. Obviously, the gold level is for investors only. You're welcome to join the investor club and get access to a massive amount of content that you don't have access to by just scanning this or going to this link. Anna, can you put in HTTPS multifamilyu/club into the chat? Sure
can.
All right. And so for those of you that want access to all of our content and have access to it throughout the year, scan the barcode or use this link that Anna's putting into the club. Into the chat. All right. Here's a shootout. We always start with U-Haul. You've seen this slide for the last 10 years, and the winner this year was somewhat surprising. So South Carolina beat Texas in terms of migration. Makes some sense because Texas is becoming more expensive. People want to migrate to inexpensive slates. Florida, North Carolina, they're pretty much where they were last year. Texas moved down a level. But the most important statistic on this site, the ones that's the aha moment, is Indiana. Indiana is up 27 spots to number 8. That is a huge jump. First time it's ever made this list, and it's moving at an astonishing speed. So keep an eye on Indiana. All right, city rankings. Our favorite city ranking group is the Milken Institute. Over the last 10 years, by the way, our projections for best cities have often matched that of Milken. But I have to say that we actually come in a year before them, right? They're a very large organization. They're very conservative. So, for example, their pick this year for City of the Year is Raleigh, North Carolina, which, if you were here a year ago, was our pick last year, right? We've also picked Austin in the past before they did. We've picked Provo before they did. We've picked Idaho Falls before they did. The most interesting one in the list, the aha moment, is this city, Ogden, Utah. I highly recommend that if you don't know about Ogden, you need to look at this. Now, I also love the Northwest Arkansas area, right? So one of the cities in the list right here at number 7 is in Northwest Arkansas, Fayetteville, Arkansas. So fantastic area, incredible growth. Here's the best performing small cities list from Milken. So same source, but small cities. These are cities, typically under, 150,000 people or lower. Once again, we've already picked in the past St. George. We've already picked Idaho Falls in the last 3 or 4 years in our internal ranking. So wonderful to see them at number 2 and at number 3. So I recommend these 2 cities. Zillow's list has Buffalo repeating at number 1. It was also number 1 last year. What's really exciting to me is this one, Indianapolis, at number 2. We have been talking about Indy for a while. It was sort of our runner-up last year as the sort of the up-and-coming city. And it's also great to see Kansas City at number 8, right? Kansas City doesn't quite have the momentum of Indianapolis, but both cities are doing extraordinarily well compared to the last 10 years. So Providence is doing really well because it's close to Boston, very hard to build there. Philadelphia is a perennial underperformer. So, happy to see Philly in the list, right? You might want to take a look at this one. But I think it's really hard to beat Indianapolis because it has much greater population growth than Buffalo or Philly. Okay, that last list, that was single family, by the way. This is the multifamily list. I know many of you are here for multifamily, right? I really like Vegas, right? This market's changing. Just like Phoenix changed after the Great Recession and it became a broader market, right? We're now starting to see that with Vegas, right? So all kinds of jobs, not just gambling, not just tourism, just, strong thumbs up from us for Vegas. One more list. This is single family. It's only for the long-term buy and hold people, right? So this is not a flip list. It's not a 3 to 5 year list. It's a 10-year list, right? We like this list because all of this stuff, it makes sense to us, right? Yes, we think Philadelphia is a 10-year market, right? Definitely look at it. Number 5, by the way, is Centerton, Arkansas. That's another city in that Northwest Arkansas metro. We saw Fayetteville a couple slides ago, right? At number 8 is Gainesville. And my favorite, by the way, in this list is Carmel, Indiana. So this is in the Indianapolis metro. It's actually the best part of Indy. So if you're looking at a 10-year investment, you really can't go wrong with Carmel, Indiana. Or the city that's actually right next to Carmel is called Fishers, Indiana. So these are our recommendations for best cities to invest in. Hopefully you took notes. We'll finish with our long-standing tradition. So I stick my neck out. I make 2 predictions. I pick the best up-and-coming markets in the US, usually smaller markets that I think have potential. And then I pick what I consider to be the best market for real estate investment in 2025. So are you guys ready?
Ready? I'm ready. I'm ready.
All right. She never gets to see these before, by the way.
Nope.
So our pick for best up-and-coming market in the US is Las Vegas. This is the first time we've featured Las Vegas in the last 10 years that we've been doing this. But the numbers, they're just so good. So many good numbers, but we highlighted just this one, right? Population growth over the last 3 years for Vegas, 4.5 times faster than the national average. Even Texas has never seen that kind of growth, right? There's just so much going on in Vegas beyond the casinos, beyond tourism, right? So enthusiastic, 2 thumbs up as the best up-and-coming market in the US. And our last slide, drum roll, our pick for the best market in the United States for real estate for 2025 is, no surprise, Indianapolis, right? We could have picked Vegas, by the way. They're both big markets, but we picked Indy because we're seeing a higher quality of job growth in Indianapolis, right? We're seeing significant institutional interest, maybe because Vegas just doesn't have a good name, right? So we're seeing very strong rent growth. We're seeing very little supply. there's just a lot of reasons why Indianapolis is a terrific market for both single family investors and also for multifamily investors. So if you are looking at multifamily specifically, look at Fishers, Indiana. If you're looking at single family, look at the city next to it called Carmel, Indiana, right? These are both in the Indy metro. And to be honest, I'm very pleased to have a city in the Midwest be our best market in the US. This is actually the first time that the Midwest has won Best City Award from us. And that's our show, folks. I hope you liked it. What you learned today is a teeny tiny fraction of the incredible knowledge, the always free knowledge that is available in our investor club. So we're planning a bunch of webinars this year, so about a dozen. Make sure you keep coming. And please answer the poll that Anna is throwing up there for you. It just has 3 questions that we want you to answer. So go ahead and answer those questions. It really, really, really helps us. And now we're happy to take your questions. You feel free to throw your favorite city at me if you like. Don't know if I'll know much about it, but
those
feel free.
questions should go in the Q&A box, please, as opposed to the chat box, because things get lost in chat. Neal, when you were talking about AI, you referred to Rule 3. What did you mean by AI will follow Rule 3? Do you recall?
No, I do not remember that. So maybe that was just a typo. I
Okay.
don't remember Rule 3. Maybe I said something slightly different.
What's your view on robotics and AI in the next 2 to 3 years, and how will this change projections?
So artificial intelligence, the biggest, the single greatest change from AI will come through robotics. Robots have been dumb, and robots are nothing new. We've been using them since the 80s. That's why cars got cheaper for a while. But they're industrial robots. They were incredibly dumb. We're about to get smart robots. But when I say about, I can tell you that I'm very keenly interested in this. I'm investing in some of the companies. There's a very good Chinese one and one good one in the US. So the US one is called Figure AI. The Chinese one, the name I can't pronounce it. And so I'm investing in these companies using private platforms that give me access to their shares. Here's the thing. It's at least 5 years out before it becomes before it becomes mainstream, before we get to the point where there's millions or tens of millions or hundreds of millions of robots. But it's the biggest change. But I don't think it has a significant impact over the next 4 to 5 years. There's still so much that needs to be resolved. Before that, we will see robots doing fries, robots making burgers. So we'll see something there, but not mass market adoption. If you're thinking like a robot in your home, you're actually thinking about something that happens more than 5 years out. There's just so many technological and legal issues to fix there that AI doesn't have for software.
Will deportation decrease rents?
Yes, it will. So if 1 million people get deported. So right now this is something that I'm curious about myself. I think it will hurt. They seem to be deporting currently about 1,000 people a day, and that's 365,000 a year. Let's say they amp it up somehow and get it to 500,000. Just so you know, the last president deported about 250,000 people. So a net increase of 250,000, yeah, I see that lowering occupancy in the US by about 0.5%, but it's not a killer. Now let's say they get really, really good at it. And instead of deporting, 500,000 people, they deport 1 million or 2 million people. Yes, it could have a significant impact on both occupancy and rent. So watch this space.
Okay, so what is your take on which cities are affordable in Arizona for senior care? I'm going to assume that's an investment question.
I would simply say I think most cities in Arizona, other than Phoenix, are affordable. I find that if you look at Tucson or Flagstaff, those are fairly affordable cities. I would probably pick Tucson over Flagstaff, but I'm not answering your question from a senior's perspective. I'm just answering your question from an affordability perspective. Phoenix is not affordable and will continue to get less and less affordable.
So let's talk about Tucson. Someone is asking specifically, separate person asking specifically, what do you think about Tucson?
So still has a lot of supply to come in. So what I would say probably the supply should end by Q3 this year. So maybe in Q4, we'll start to see more powerful rent growth. So maybe get into contract in Q3. Rent growth projections for 2025 are not impressive in Tucson, just so you know. They're in that 2 to 3% range. So we think it's a good market. We don't think it's a great market right now. I still think that there's just a lot going on in Arizona, a lot of supply to be worked through. It's also very easy to build in Tucson. So keep in mind, Tucson's a little bit like Houston, right? You can just keep on building
Sprawl.
infinitely. Yeah,
Yeah.
there's just sprawl. There's just sprawl.
Can you comment on your predictions from last year?
I think we did really well with inflation, with GDP. Um, we didn't do as well as we would have liked with rate cuts. So the Fed cut 4 times. I was more bullish. I felt like we would get 5 or 6 rate cuts. We got the 4. So didn't do well on those. Did really well with Raleigh. Raleigh has actually done fantastically well in sales prices, even though it's been hit with rents. So our pick for last year was phenomenal. As you saw, Milken picked Raleigh as their top city this year. So we came in ahead of them, and we really love Milken. We think they have an incredible methodology of ranking cities. The rest, I don't know. I don't quite remember. That deck is available to anyone that's in our investor club, so you can match it up and you can throw it at me.
So a couple people you mentioned at the beginning, the very beginning of the presentation, that Grow Capitalist would be just exiting something this year, and a couple people are wondering what project is exiting, what
Hopefully, we're
market.
looking to exit. Yeah, we're hopefully looking to exit our St. George property, Coyote Creek. So we have a decision to make there. We might exit, we might extend, but there's certainly it's on the table to exit. We also have a industrial project called Woods Cross that we are, contemplating exiting. So between the two of them, probably an exit.
Mhm. All depends on the markets.
Mhm.
Um, what's happening in Philly besides winning Super Bowl? It's on top of a few lists.
So firstly, I'd like to
Why
tell
is it?
you, if the
Mhm.
Super Bowl is a big thing. The people have done academic studies, very detailed studies of what happens to a city after it wins the Super Bowl. So firstly, the economic value of winning the Super Bowl is well over $2 billion. 2 billion doesn't seem
Wow.
like a large number for the country, but it's actually a pretty large number for a city to gain $2 billion. So it's a very big deal. People get more bullish, they get happier. And that effect is short term, but it still allows them to make investments and do interesting things. So never count out the Super Bowl. Um, the second thing that's happening in Philly is its education levels are pretty high for, when you compare it with other cities that haven't done well. So it's a perennial underperformer, hasn't done well. It has very inexpensive real estate. So that's really the biggest thing that I can think of. And growth is coming back to Philly. So Philly used to be one of the biggest cities in the US 100 years ago. So it lost a lot of population. That's no longer the case. The population growth is stable and going up a little bit. So is it growing as fast as Kansas City or Indianapolis? Not quite. But it has very reasonable real estate. So that's in favor. Cash flow for sure.
Let's see. Will tariffs and counter tariffs cause inflation to rise in Q2? If so, would that hinder the short-term vacation rental market?
So the honest answer is when inflation goes up, it hinders everything. So I don't expect that short-term rentals will be more hindered than regular renters or less hindered. It's just a hindrance, right? I mean, rising, higher inflation creates problems. But generally, 2 to 3% inflation doesn't create substantial problems for either short-term rentals or regular rentals. 4%, 5%, yeah, because if you go into the 4%, then the Fed has to raise rates. Once you raise rates, mortgages go up, everything gets more expensive. It's harder to make money on any kind of rentals, not just short-term rentals.
What should a passive investor reasonably expect to earn annually over the next 1 to 2 years? Let's make the assumption that it's a new investment. So if somebody going into, so what would a passive investor, let's say in an existing asset, not a new construction?
Sure. If we're only talking about cash flow, because remember, a lot of these investments are 5-year, 6-year investments, right? So who knows what the investment's going to make in the long run? But cash flow, 5% is the number, and I'm sorry it's not higher, but that's what it is. A lot of real estate now is value based, growth based, and a lot of that comes when you sell.
Yeah, exactly. Okay, I am going to ask you about specific cities, and you can choose to either comment as single family or multifamily, depending on what you know more about. Okay, so we're going to
Sure.
hit a bunch of them.
Sure.
Little Rock, Arkansas.
You know what? Over the last year, a lot of discussions have come up about Little Rock. I have to tell you this. Northwest Arkansas is leaps and bounds better than Little Rock. Little Rock still has some very bad crime issues. Having said that, we have noticed that it is slowly climbing up our charts. So what I
It
would say
is.
is be very careful in terms of crime. You might get into a building
Neighborhood.
that's really really bad. So I think it's really block by block. But
Hmm.
there's definitely upward momentum, and we have noticed it. Are we going to go buy something in Little Rock? No.
Detroit.
So Detroit still continues to be at the very bottom of everyone's list, including Milken. So if you look at, all of the rankings in the United States, Detroit continues to be at the bottom, along with cities in Louisiana, in West Virginia. Um, I honestly feel that Detroit is a hype city. I think the suburbs of Detroit are wonderful places. You can get good rents there. But to but people who assume that somehow Detroit is going to turn around, these are the same people that have been saying it since the 60s, the 70s, the 80s, the 90s, the 2000s, and the 2010s. At no point have I seen Detroit come off the bottom, and I don't particularly see a reason for it to come off the bottom now. As I said, the suburbs are good, and there's probably some decent rent growth and deals to be made.
West side of Houston, like Katy and Sealy.
I really like that area. Yes. So if I was investing in Houston, and I'm not, I'm worried about insurance costs in Houston. I'm not worried about insurance costs particularly in all of Texas as much, but I'm worried about insurance costs in Houston, so I don't invest there. But if I was going to invest in Houston, I would drive directly west on the freeway that leaves downtown, going towards Katy, and I'd probably go as far as Katy or even a little bit further to invest.
Fort Wayne, Indiana.
So I would probably place it, behind Indianapolis in terms of markets that I like, but it has also been climbing our charts on an ongoing basis. You can't build there because the rents are too low, but you can buy there. So, if you live in Indiana and for some reason you like Fort Wayne more than Indianapolis, I can't say it's a bad market. I think there's significant benefits to going to Fort Wayne. I just prefer Indy.
What cities do you like in South Carolina?
It's interesting. I like to say Colombia, but I don't like the crime levels in
Hmm.
Colombia. So I like where Anna is. Anna, what are those markets?
Charleston.
Charleston. So
Charleston.
Charleston and then Myrtle Beach, right? So Charleston maybe, getting a little like on the expensive side, but if you look at the corridor between Charleston and Myrtle Beach, so go a little bit further down that corridor, you might find something that works, right? So again, insurance is an issue and it's an X factor, but hey, you like South Carolina, so.
Atlanta.
Atlanta is showing good numbers this year, so I didn't expect it to do as well from a rent growth perspective. It did have a huge amount of supply, but it's bouncing back quicker than I thought, which I'm pleased by. We have one property there, so not a huge portion of our portfolio, but it's definitely bouncing back faster than I thought. Um, Job growth is strong, so yeah, it looks like it's doing good.
Looks like it might have a good year. What about your thoughts on investing in California and the outlook on insurance after these major fires?
It's a crapshoot. So there's a lot of people that basically think that they're just going to waltz into these, homes that are, done, and they're going to buy that land for cheap, and they're going to build something. Good luck with this. Just because California wants these homes back as quickly as possible doesn't mean that you can get there. They didn't just lose their homes. The infrastructure is gone. There's no power lines anymore. Roads were burnt down. Schools are gone. Fire stations are gone. Utility houses are gone. The entire city is gone. So to just simply think that I'm just going to go into this area, Altamont, or I'm going to go into the cities that burned down, I'm going to buy something and I'm going to just rebuild it and make huge amounts of money. Well, good luck to you.
Cleveland.
Climbing our charts as well. I am not fond of Cleveland. I always like to rank the Ohio cities as Columbus, Cincinnati, Cleveland, Dayton, right? So it's third in that list, but I cannot ignore the fact that it has had significant rent growth in the last 12 months, and it is projected to have significant rent growth in the next 12 months. So can't bash it as much as I used to.
Fayetteville, North Carolina.
It's an interesting market. I think that um, I like the other one that starts with a W that's on the coast, Wilmington, a little bit more than Fayetteville. So I would probably pick Wilmington over Fayetteville. Problem with Fayetteville is it should have benefited more from the Raleigh boom because it's close, fairly close to Raleigh, but it hasn't. I mean, when I look at rents, I'm not super impressed.
What about Durham? Durham is close to Raleigh.
Sure.
Will it benefit from Raleigh's shine?
Absolutely, but in 2026. So Durham in 2025 still has a huge, huge amount of supply. So my feedback is I think prices in Durham are going to get more depressed in some categories, maybe not single family, but maybe multifamily in this year. So you may want to look at going into Durham next year because I think Durham is a strong market. I think, Raleigh is, I mean, according to Milken, the best market in the United States. I really can't disagree. And so being the market next to the best market is pretty awesome. Like, Oakland is next to the San Francisco Bay Area. Have you seen prices there? I'm not fond of Oakland. I live in the Bay Area. I'm not fond of going into Oakland, but the prices are pretty awesome. So I think Durham is going to benefit from the Raleigh shine, but be aware that rent growth this year is probably going to be really shitty.
Trying to find this question. What do you consider to be the most landlord-friendly cities to invest in?
I used to say things like Texas, but it's not. I mean, Texas has become this crazy purple state where, they don't like landlords anymore, which is nuts. Texas is losing its brand. So I'd say Arkansas is pretty good. Arizona. So I'd say all of Arizona is pretty good. So is Nevada. So you can evict people in about 3 weeks, 4 weeks in Reno and Vegas. In general, every state that I've seen over the next 10 years has become less landlord friendly
I agree with that
to different
from a
levels.
practical
So
standpoint.
the
Yeah.
2 week evictions are gone. Most, 2 week eviction states are now 4 week eviction states or 5 week eviction states. It's just there's more bureaucracy.
Yep. Yep. I agree. Well, Neal, we are over time. I'm wondering if you want to just pick maybe two questions. Lots of cities people were throwing out there. We tried to get as many as we could.
Yep. Let me see. Mm, let me see. Hmm. Well, I'm going to answer a question regarding one of our properties. So rents in Killeen, Texas are going down. How's your project in Country Place? Steve, we've taken the project from, a low occupancy to a 97% occupancy, and we've sent you screenshots. Our property has positive rent growth. So yeah, we've seen some negative rent growth in Killeen. That's just because of what's happening in Austin. As you know, it's a Austin metro market, but not our property. So we've had spectacular gains in occupancy and less than spectacular but solid gains in rents. So check out our numbers in our updates. Um, is urban doom loop still of concern? No longer. So, enough people have returned to markets like New York and Los Angeles for us to say these markets got hit very hard. They didn't get the rent growth, the population growth that they were supposed to get because of COVID. But the urban doom loop is not as powerful anymore. So it's not happening as much. We'll take maybe one more. From the data presented today, it looks like we've avoided the commercial real estate bloodbath. Yes, there never was a commercial real estate bloodbath. We talked about some distress. We talked about prices going down. That's what happened. Prices went down 20%, a lot of pressure. If you consider that bloodbath, sure, it happened. Did any property anywhere in the United States sell on a courthouse step? Absolutely not, and it was never going to happen. In the last year, we've made about 35 offers. We've lost every single offer, and we've only got into 5 best and finals in an entire year, right? What bloodbath.
That is
All right,
true. All right.
we'll
Well,
take that.
fantastic
Yeah.
job, Neal. Great
Awesome.
data.
Well, thanks everyone. There were 400 of you, so terrific to see you. We'll send this out to you guys as a recording, and please keep coming. We have a terrific set of webinars for this year. And thank you, Anna, for co-hosting the webinar with me.
Yep. Happy to.